Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, December 20th, 2018. If you are a member of the site, most everything I'm going to cover in this video is what I covered in the earlier video today. That was for members only. I'm going to go over the same things I went over there, maybe a few other things. So if you get nothing but time on your hands, you may want to watch it. But again, I want to kind of recap this as general market analysis. I covered some trade ideas with price targets and the other one, some other things were member only content. But I just want to do a broad overview of what happened today in the markets, what I'm seeing, and maybe give some of the additional commentary that I gave in that earlier video today. Starting out here with SPY, so not a whole lot new to report. We're down 1.6% today. So another down day. The downtrend continues, and as I mentioned today, again to recap what I've been saying recently, is I was looking for a move down. We had a comment in the trading room today. Someone said, Randy, you were looking for a move down to QQQ 152 for since before this thing started, and you nailed that. Now, how are you getting bullish at this time when all the trend indicators are pointing down? And my response to that was, and also to digress for a second, somebody asked on another question on a related note, hey, is it possible that divergences don't work in bear markets? When we have positive divergence, is that possible? Well, my answer to that was it's the same divergences in reverse, bullish divergence, or I'm sorry, negative bearish divergences that were the a big part of the scope of the move, not only calling a top here right after we broke down and given a sell signal, but how far we would go down. And remember, this came at the height of one of, if not the strongest and longest bull markets in history. So if negative divergences work in bull markets, positive divergences can certainly work in bear markets. And I also did a video earlier this week showing you the 3 times that we had negative divergences in the bear market back in 08, one of the most vicious bear markets on record, and they were still good for very profitable counter trend rallies. Now, with that being said, and I say this over and over again, but it bears repeating because I have the same question come at me time and time again, positive and negative divergence in themselves are not buy or sell signals, not even remotely close. They're merely indications that a pending trend change is likely. And divergences sometimes get burned out. So, the question, will these divergences work? Number one, I would say if we get them confirmed, there's probably about a 90% chance it'll lead to a significant rally, significant being 8 or 10% or more, if they're confirmed. What makes it confirmed? As I said, when the PPO makes a bullish crossover to effectively put in an equal or higher low. As of now, the trend indicators, the momentum indicators are pointing lower, RSI and PPO. And so as such, I keep referring to these as potential divergences. Why? Because we can just keep moving down, 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 down. And then once the PPO has effectively taken out that previous low and the RSI has done the same, then you no longer have bullish divergences. So now what would it take for that? It would take a meltdown scenario. And like I said, I continue to say the markets are in a very precarious technical posture. The selling pressure is very strong recently. Everything I talked about in recent months about the hedge funds and pension plans being caught off guard with a large equity exposure. God knows why, 10 plus years into one of the longest economic expansions in history and longest bull markets. But that's what they were. And then what happened, the icing on the cake, was the fact that early on we had all asset classes falling. Treasury bonds, gold, industrial metals, real estate, everything was dropping. So therefore, their asset allocation models or risk models, broke is what happened. And so I think that's led to a lot of forced selling, and then couple in everything else I talked about, the margin bubble, the interest bubble, and or I should say debt bubble, the margin bubble and debt bubble, all one and the same. Margin is debt, margin interest, and the indexing bubble that many have talked about for years and the market has just ignored, in which there's been an unprecedented trend into index investing, and that works great when money's still coming in. It's almost like a Ponzi scheme, if you will. That's you could equate this market to a Ponzi scheme to an extent. Please don't take those words out of context, but in the fact that as long as new money is coming in, it works. And as I'm talking about indexing, new money feeds in, but what it does, it pushes up stocks, not based on their fundamentals and their true valuation or net worth, but the fact that money is flowing into an index, and if they're part of the index, they get lifted. And So when the money flows turn, and that's what's happened here, investors start panicking, pulling money out of their 401ks, IRAs, mutual funds, individual stocks, and the good get sold with the bad, and the ones that get hit hardest are those market leaders: Amazon, Facebook, Apple, etc. All right, so that's what's happened. And again, that's stuff I've talked about, for months now. So nothing new today. Let's just get back to what happened today. So again, another down day. Really nothing different from the norm lately. We've been in this very impulsive leg down, and we undercut the lows. So all along, looking for a test of these lows, some really back, shortly after they happened, and once we got that, I said we would see one of two things most likely. We would either reverse just shy of the lows or undercut the lows before reversing. Because if too many eyes are watching one level, it almost never happens that you'll reverse there. So we had the latter of the two scenarios. We flushed through. And again, I still maintain what I've been saying for about a week or so now, that I think it's a good scale in opportunity. And I continue to do that too. Scale in, with long-term 401k money. Use today as another opportunity to add some more. No reason to be at a fully, net long equity exposure yet, but I think, we're getting really close to that point where, if nothing else, valuations are really coming back into play. Remember, we're not in a recession. You'll always, the government will tell you you're in a recession long after it's happened, long after the market has told you. So no, it doesn't matter to me whether we're in a recession or not, but the underpinnings right now are pretty strong. This is just more of a market was caught off guard with all those asset classes dropping, and again, an unwinding of a credit bubble, a lot of margin calls, forced selling, and scrambling by big institutions to protect their downside. So anyways, it looks to me we're probably close to being done. Cannot rule out, nor can you ever, of a big, like a mini crash type, we had back in, what was it, 2010, a flash crash or anything like that. You get those when they come. It comes when the market's under pressure. Black Monday back in '87 came after the market had already started moving down. You don't usually get those right off a high. So I have to say that, and I think it bears repeating that you cannot rule out the risk of a sudden, big type crash where the market goes down. I mean, circuit breakers will hit if it goes down too much. They halt trading for a while, cools down. If you keep going down, then they shut trading down for the day. Hey, anything's possible. I don't think we'll see that, but I do want to say it's possible. So that's why you don't go betting the farm just because we're down. So we say oversold in itself, divergences in themselves, those are all not buy signals. We don't have any buy signals yet. So if you wait for one, my guess it's going to be a big move up. When we finally get one, you'll have a big green candle. And I talked about that today. I added for the first time in quite a long time. I've added some 2 long trades on the equity index markets, a QQQ and IWM official trades on the site. There's a big difference of saying I'm looking for a bottom here, scaling in, actively trading versus putting on swing trades. And what I said to the members of the site on those, in the comments on those trades, if they get stopped out, so be it. We have stops. That's what they're there for, and we'll just get it the next time around. The risk reward, I think, is excellent from where we entered, assuming we're not stopped out and we do reverse, like I've been saying now. I started last week saying I expected the markets would likely bottom this week, and I still think there's a good possibility of that. Possibly today's lows. We don't have really signs. This candle today didn't tell us much. It doesn't look any different from the others. You zoom in, you can see they all have a little bit about equal wicks on the bottom. That means we didn't close at the lows any of those days, and I'm referring to the last 1, 2, 3, 4 days now. So really nothing new here, and nothing to say that today looked or felt like a bottom. You can say it felt like whatever you want, but more of the same. So we need to see pretty big candle. And when you get a pretty sharp, powerful sell-off like this, these kind of slides, you usually don't see a bottom that looks like this, where you just pound around for a while and work your way up. Usually you get this. You get a V bottom after very strong and sharp selling. So that's what I think we'll get here. And somebody talked today in the trading room, said something about trying to nail a bottom. you don't have to nail a bottom. At least I think you scaling in, and that's what I've been doing over the last week, and I'll continue to do going forward for the next week or so, until I get to an allotment that I feel comfortable. And then at which point, when we get pretty decent evidence, and it might be one, it might be two, it might be three or four candles. When we have decent evidence of a bottom, and it's not just candles, price action, key technical levels being recovered, other things like that. At that point, then I'll move to what I deem necessary, a full equity allocation for the market conditions. That does not mean 100% long. It could, but it depends on the account, whether it's a trading account, 401k. I don't think, I do view this any rally coming up as a bear market rally, and as such, probably not a good idea to be 100% fully invested. But if you want to game what could be, 8, 10+% rally, that's what I'm looking at. So let's move on. Finish up with the charts here. Let's look at QQQ. I showed you SPY. QQQ now didn't have equal lows. SPY, those lows were almost equal. I'm talking about the February low and then the subsequent April low. QQQ had a low down here. So what I did is I put, this is the range right here. And these aren't the exact numbers, but you can see the lines are roughly there. And so we pretty much came down to that January low right there, or February low, right about there today. And we still have the potential divergences in place, and we're at support. Remember, SPY did that undercut scenario where it undercut the lows, and SPY or the S&P 500 is much more indicative of the U.S. economy. It's much more diversified. It has more balance among the different sectors. It has financial stocks, for example, which QQQ does not. QQQ is really a tech fund with an Amazon kicker, I jokingly say, because it's, I think, it's 60-something% technology stocks. Amazon's a heavy weighting in there, and it's not as diversified as most indexes are. So there's QQQ. Now I want to show you a couple other things here, and this is what I showed the members in the video today. Let's take a look at, I'll start here with MDY. Okay, so again, to the point that, I've been looking for a correction, this correction, not just a correction, but a pretty bad one. And again, you have to address the technicals as they come. The selling that we had recently, increased the odds that we'd come down here to my, what I called, if things get ugly, target. Now, what I'm talking about here, let me see if I can expand this. Okay, close enough. All right, so all the charts on the right side of the chart, as well as the videos, are all time-stamped and watermarked. So this was back in September 27th, right around the time we topped here. And I listed, some near-term targets. And then if things got ugly, target number 1. If things get ugly, target number 2, which obviously those have been hit. And finally, if things get very ugly, and that would be, it is and was my final target zone. And obviously, guys, things did get ugly. I think we can all agree on that, whether you're bull or bear or whoever you are. All right, so let's look at MDY today. Okay, so you can see that was there around about 305 down to just above 300. And we go back to the chart here, clear that one out, MDY. And there it is. So that's what happened. Things got ugly. You can see we had reactions. These are all target zones here. This sell-off, the fact it started with such a bang so impulsively, shot right down through those first couple early shallow targets. And then you can see a near perfect tag of if things get ugly, target 1, a reaction. Kind of undercut on a momentum fueled overshoot. That target 2 had a rally there, found support on a little, we didn't have the same downward velocity, so we didn't have that momentum fueled overshoot. And if you're new to my analysis, I've used that term for years, something I made up, momentum fueled overshoot. From my experience, when you have a tremendous amount of downward or upward velocity on a stock or an index, in this case it's downward velocity, just like you had back here, that momentum will often carry the index or the security beyond the support level that it would have and is meant to find resistance on. For example, here on MDY, you could see was very nice support right here, and it overshot that briefly, just a couple intraday candles. Those are momentum fueled overshoots, and then snapped right back above there. You can see, all 3 days it traded right on or above that, closed right on or above that level after overshooting it. So those are momentum fueled overshoots, and that's, I think, what happened today. Time will tell, because we're in a precarious position. We've undercut that support. I mean, this support zone, this target zone, was a support zone. You can see all the reactions here and some down here and a little to the left of the chart. So we closed right about on the bottom of that support zone there, just like we closed just a hair below it there. But that's, that was my scenario then. That's still my scenario now. The fact that everything has played out, the way it has, makes me continue to think it'll play out. But I want to say this, and I mentioned this in the video today. That's also dangerous to have a bias just because everything has played out to where I have thought it would so far. It must continue to, things must continue to play out in the way I expected, 4 or 5 months ago. That would be, a little bit of a bias. If I couldn't make the case I've been making recently, I wouldn't be looking for a bounce. And I also want to say that I'm not a foaming diehard, foaming in the mouth bull right now. I've been scaling in. I think we'll get a reversal here very soon, but it's not by any means an all-in. Trickling out a couple long trade ideas today on the indexes. Plenty of stock sectors, and I can't rule out, big washout move. So, we'll keep our stops relatively tight. Again, trading is all about risk reward. Limit your downside loss, and we have pretty attractive risk reward ratios on those trades, relative to when you look at the stops compared to the price targets. And so that's what I wanted to share. There's MDY down to where I figured it'd be heading, and then I have one more to show you here. Again, these were all covered in this morning's video for members. Back then, this was an old chart I since revived. This was back in September 17th, and I showed QQQ coming down here. I showed it at 156, and and in subsequent videos and analysis, I started marking my line right around those two lows there, the reaction lows. So, and QQQ, like I said, has now come down and hit that January low. I showed you that chart earlier. So again, these were things. This is a move that was anticipated back before it even happened. Why? Well, and how would I know such a big move coming? How could I forecast that? Again, it's a lot of factors go into it, not just the divergences, but the scope of these divergences. They're big, powerful divergences. We had multi-year uptrend lines that broke, and they did work. And again, this was at the height of one of, if not the strongest bull market in history. So, if if negative divergences work in a bull market, I don't see why positive divergences won't play out, especially, of course, if we get confirmation, some kind of reversal soon, and then we get a bullish crossover. So I guess the takeaway is don't underestimate how far the next rally might go. There was a lot of buzz in the trading room today where people are saying, well, okay, we're going to get a bounce soon, but it's going to be very shallow, and you need to short into it because everything's been so bad. Be careful with that. I'll do my best to try to navigate, if we do reverse soon and start to rally, try to look out. And of course, it will not be a straight shot up. There'll be some zigs and zags along the way. But as far as putting back on swing shorts, we pop 3, 5, 6%. We may keep going from there, but it works the same way in reverse, just like those going long right now. Let's go back to today's charts. Just like those going long right now, if you went long here today or anytime recently, don't fall in love with it. That's what stops are for. If you're long IWM, I think, stop below today's lows. We may pierce that tomorrow. If we're going to get a reversal, like I said, we still have one trading day left in the week, maybe a down and then reversal. We don't have a lot of, really any candlesticks today that shows that we bottomed. But we're getting stretched here, getting stretched on the divergences. And these aren't be-all, end-alls. Doesn't mean that if the divergences are taken out, that we can't reverse. But I would just, again, you have to limit your stop somewhere because you can't rule out some type of flash crash, especially with everything going on now that I talked about earlier about the leverage unwinding, margin calls. So a lot of hedge funds have been blowing up lately. We know that, and that, of course, leads to forced selling and liquidation, stuff like that. So again, it's dangerous times, and at the end of the day, if you don't know whether you should be long or short, be in cash. I've been saying that for quite a while, and I still think that's the best place for a lot of people to be, especially those risk averse or those that aren't flexible and have the time to devote to this, and or for example, 401k money where you can't use stop loss orders. You have to just manage that on a day-by-day basis, and you go in, and no matter when you tell them to buy or sell, that goes through at the end of the day at 4 p.m. those orders. Okay, just a couple more things that stand out, and we'll wrap this up. All right, here's the VIX. Remember yesterday, I believe it was, I said we're really pushing on this 25.58 resistance. We popped above it today, but as far as the VIX goes, and you might say, wow, that's a big gain. That's run of the mill, especially considering what's going on in the market right now. When Mr. VIX wants to move, he can move. These are, you can see that candle back here. So an 11, 12% gain is run of the mill. Now, not to be dismissed, but what I am pointing out is, and I mentioned yesterday, any new high will be a divergent high. Why does that matter? Again, either you put stock into these divergences or you don't. It seems I get so much friction because I guess it's a big part of my trading. I understand a lot of traders don't use them the way I do, or maybe they do and not as consistently. But again, you can see in this chart, and these aren't things I just added. They've been here a long time. Look at these divergent lows. They're all marked. Divergent low right here, rally. Divergent low, rally. Divergent low, rally. So likewise, is it coincidence that this divergent high, and by the way, these divergent lows typically, I believe each instance came with divergent highs in the stock market. The VIX is almost it's not a perfect inverse. It's not going to, but it tends to bottom and top with the market. So is it any coincidence that, or mere coincidence that we have a divergent low right now, or potential divergent low in the stock market and a potential divergent high in the VIX? No, not coincidence. This one's not confirmed yet. We still need to turn back down, put in a lower low, meaning below this low. So right now it's heading up. So, there's certainly room for a little more upside. But I still maintain either this week, we'll see if we get it Friday, but if not, I'm thinking Monday. If they close the market down red, my thoughts tomorrow, if they can't close it green, in really healthy green, where it looks like some kind of bottom might have been put in, then it's going to keep everybody guessing over the weekend. There's a good chance the futures will trade down Sunday night. When U.S. markets close, then the Asian and overseas markets open after ours, and so they usually follow our lead and they go down. And then our futures will trade down with them. So anyways, that could happen Sunday night. Give us a little flush out move in the morning. Again, one possible scenario, but either way, it looks to me like the tradable bottom is in. And now if we get if we do get a kind of a meltdown, mini crash type scenario, then yeah, we may go in. VIX could run back up to 50 like it did here before. More than that. So you can't rule that out. That's all I'm trying to say. I'm not trying to give you conflicting analysis. I'm just not going to sit here and emphatically tell you that a bottom is in, that this market cannot go lower, especially at this point in time, because that would be, I think, naive of me or anybody to say. Okay, we actually closed out 2 trades today, both profitable. We closed out gold. I'm not going to show you that board because I have one more price target. I put gold on as a swing trade and a long-term trade. On the right side of the chart, I categorize those 2 different categories. Swing trades are your typical swing trades that last, on average, usually a few weeks to a few months. Can be sometimes days if it's explosive, sometimes it can go longer. Whereas trend trades are trades expected to hold at least 6 months, sometimes a year or more. And so we hit the second target, which was I made that the final target for the swing trade in gold, and we got out right before the highs today, right before the reversal. So what I'm getting at with that, and I do have a longer term target for long-term traders that want to hold, that's still active trade there with one more price target. That's why I'm not using that board here. But it's pretty decent resistance. You can look at the line I have here. And of course, that's why we had our second target set up here. That's not exactly where the second target was. I revised it just a hair below and we got out. But we can see this potential doji stick here. A doji is a potential topping stick. Here, let me zoom in. So you had resistance there. And even if you don't trade gold, where I'm going is with the stock market on this. There was a doji right there that served as a topping stick. They're not all topping sticks, but sometimes they are after an extended uptrend, especially at resistance. So if you see tomorrow or next week, big red candle following through, especially a couple red candles, there's a good chance that we have a near-term top in gold. And why I'm saying that is gold isn't going up supply and demand. It's not, gold is an industrial metal as well as a precious metal. It's used for jewelry, but it's also used as a flight to safety bid. It always has been. Some people don't understand it, don't understand why, they don't get it, but it has been. So you just have to go with that. And part of why we entered this trade is when it wasn't doing well recently, along with Treasury bonds, I said it would. I said this market will keep going down, and mark my words, you'll get a flight to safety in Treasuries and gold. And I cited fundamentals and technical reasons, and we've gotten that. So now where am I going with this? Well, if I'm correct in exiting this position today on the swing trade, and my analysis is correct, and gold comes in and corrects, I'm looking for pullback at least down here, some 117.40 or so, but that will show us a exit from a flight to safety bid. Remember, gold and Treasury bonds are probably the two go-to flight to safety bids, flight to safety instruments, excuse me, other than cash. So if you start to see profit taken in gold, again, gold has moved up more so than other metals like platinum and silver. Again, and that's showing it's not a rally in the industrial uses of these metals. It's most a flight to safety bid right now in gold. And so gold along with TLT, and that one I can show you because we closed this out. I closed it out recently. This was an official long trade. We went long somewhere here and closed it out when it hit T2. I had this as the final target, former T3 at 122.13. I decided earlier this week to just close it out here. We had a downtrend line, and that was my second target. So we hit that one, and I even stated at the time, longer term investors, trend traders, dividend and income investors might continue to hold because the longer term outlook looks good. However, T3 was my final target. When I put final targets on a trade on the right side of the chart, it usually, not always, but normally that's an area that I expect a trend reversal, that trade to end. And usually if you go back, you can view all the completed trades on the right side of the chart. That's one thing I think I do different than any other site out there. Every single trade ever since 2012 January when the site started, they're all there. You take some time to go through the archives, but you can see all the trades, all the posts. They're under completed trades, including this one. And so when you get a final target, you usually get a decent reversal. So from both a technical reason, and you can see it's a pretty decent resistance area, and this may have just been a technical pullback today, but you can see a big red candle off there, off that final target area. If we get more follow through, what does that show me? It tells me, and again, there's a little more work to be done. This is a 1 minute chart. Institutions started selling today. Remember, the market was going down most of the day, and I noticed early on treasuries were going down. And if that trend continues, as I often say, one day does not make a trend, but if it does continue, that would show that the institutions are now starting to unwind that flight to safety bid, that they don't see a lot more downside in equities, so they're going to sell those treasuries, take profits. It's safe to stick their, head back out of the sand or whatever, and maybe start deploying some of that cash back into equities. So let's watch Treasury bonds because, again, it's been certainly catching a flight to safety bid recently. And if we continue to see that, I really doubt you'll see the market melt down with Treasuries going down as well. And that's about it. Long video. Again, a lot of what I covered earlier today, but we'll see what happens. But these are some of the things that I watch. You can watch a stock market. You can look at it all day long, try to extract clues. But I think when you can look at other, related assets, these flight to safety assets, treasury, gold, and, take it all together. And like I said, that's where I think we're at. I think we're very close to where we're looking at a nice tradable rally in equities. Maybe we continue to get some tax loss selling at the, in the last few trading sessions of the year. Maybe not. We'll see. So I'll follow up tomorrow. We'll see what happens from there. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.